So from the previous panel where we were talking about adoption, how it's happening in the real world, this panel we're going to focus on what does that mean in terms of investment? How do you translate that into investment? And so the theme of this panel is finding durable winners in the adoption cycle. So we're going to talk about, that's going to be the overall theme, how professional liquid managers distinguish between lasting adoption from temporary narratives. So we'll talk about that some. So you just heard Srini, he's my partner at Newform Liquid. We run a multi-manager portfolio. I have with me two of our core horses of our portfolio, Joe Naggar from Feynman Point Asset Management and Greg Girasole from Motus Capital Management. I'll just make a quick opening remark, and then I'll ask them to introduce themselves to you guys. So we've spent years talking about when institutions would come to the digital market space, when regulation would improve, when blockchain would solve real problems. This year, the conversation has changed. Adoption it's not theoretical anymore. We just talked about that in the last panel. Stable coins are now settling billions. Tokenization is reaching traditional finance. Institutions are beginning to participate in meaningful size. The challenge for investors is identifying that the adoption. What is it actually happening? And when it is happening, where does the value actually accrue? And so these guys are going to help us talk about that and help us learn more about that. These guys, Srini and I always enjoy talking with Joe and Greg. We look forward to our conversations with them. They're very thoughtful. They always have important insights on the market to communicate to us. And on top of that, they also have really good numbers to back that up. So kudos to them. So I'm going to turn it over to Joe and Greg to introduce themselves, and then I'll start with some questions. And so Joe, why don't you start us off?
Great, thank you, Phil, and thank you, Srini, for inviting me. So Joe Naggar, I'm the CEO and CIO of Feynman Point Asset Management. We're an asset manager focused on digital and really kind of frontier technology, which I think digital is core to. We've been in operation for over 4 years, going on our 5th, and really active trading, but also starting with value kind of as the kind of core driver. We take concentrated positions. We change a lot. So when we look at our portfolio today, it looks a lot different than it was 6 months ago. It looks a lot different than it was a year ago. But that shouldn't be surprising because things are evolving. So that's I think what we're going to talk about today. My background before building out this business, I was a partner at Golden Tree Asset Management, a large credit distressed firm. I was there for about a little bit over 16 years. I was on the executive committee. I ran the securitized products part, asset backs, as well as chaired our macro and risk committee while I was there.
Greg?
All right. Thank you, Phil. And thank you, Srini. So I'm Greg Girasole. I'm one of the founding partners of Motus Capital Management. We run the Motus Digital Growth Fund. So we invest purely in liquid tokens with a fundamental bias, certainly with a macro overlay. And we trade around kind of positions and other themes we see in the market. We're going on a little over 4 years as well. And so far, so good on that. Before Motus, I was an equity portfolio manager at Citi Investment Management. And then, I didn't know I needed a soundtrack, but I appreciate it. So I invested in crypto in 2016 with my two partners now. And we kind of took the traditional fundamental lens of how you'd underwrite equities or any other business and applied that to crypto. And I think the market is absolutely headed that way, where if a token doesn't have any value accrual, it hasn't done very well. And even a year like this, where I think most people view crypto as down, there are plenty of investments that are up substantially, and they all have that kind of value accrual attached to them. So I guess, we'll get
We'll
more
take
into
it
that.
from there, yeah. So I have a slide, as I talk, if you guys could put that up for me, that'd be helpful. And it'll help the audience follow along. So there are 4 topics we want to cover today. We'll start with the first one, which is what does adoption look like? Great. Defining adoption. So everyone uses the word adoption. You can't open an email summarizing digital markets without seeing a section related to adoption on it. So you guys, as investors, how do you define adoption? Like, what are the key things you look for? Why don't I start with you, Joe?
Sure. So I think what's very exciting about markets that are developing, like digital, and digital's been kind of growing for a long time, right? Bitcoin started in 2009. That was the revolution, and then you sort of move on to, Ethereum with the smart contracts, and then you have, what are called decentralized applications being built on Ethereum, because the smart contracts look a lot like Amazon on the web. And then you have, sort of this build out. Now today, when you look in the tokens, there's probably over 20,000 tokens. That's a lot of tokens. And not all of them, do the same thing. Some of them do what Ethereum does, called layer 1s. You actually have layer 2s, which are built on top of it, kind of like wholesale infrastructure. You have specific companies like, I'll give an example, like Hyperliquid, which is like a decentralized exchange, much more analogous to NASDAQ, but without a lot of people and just software, to blockchains that are designed for AI specifically, or other types of purposes that are maybe focused around the consumer, maybe around decentralized infrastructure. So there's all different types of protocols. So defining adoption is actually kind of hard, because it depends a little bit on what you're looking at. And that shouldn't be that surprising, because A, the technology is emerging, and B, like companies, what you look at and what you define as adoption changes based on what you're looking at. So, maybe using some examples. When you think about like a layer 1, where you're talking about core infrastructure, where blocks are being held, where you have immutable transactions happening, that's sort of Bitcoin, but then it's also categorically a bunch of others. You start to go into wanting to look at how many addresses are happening, how many transactions are happening. You want to look at essentially maybe other metrics. If there's some sort of revenue accrual or other components to it, like mining, like on Bitcoin, what are the miners and the other parts of the ecosystem getting? So layer 1s have a very different thing than, for example, what you might look at for an exchange. So Hyperliquid being probably the most, it is the most successful decentralized exchange in the market, has 80% of the decentralized exchange volume. They're running at revenues that are quite impressive, hundreds of millions of dollars of EBITDA. So if you want to kind of turn it into a company. But when you look at the ways to look at Hyperliquid, you're looking at a whole different set of metrics. You're looking at trading volumes, and you might be looking at the perpetuals. The perpetuals are running like 3 to 8 billion of volume per day. Enormous. And this is all the stuff that was just talked about on the previous panel is already being done on equities, on commodities, on other tokens from a trading perspective with 20 people. But you look at revenue, you look at the trading volumes, you look at new proposals that are being made that might expand their ability. So adoption changes. There's also interesting things like, and we'll talk more about the opportunity when we get to in the next section, is there are sometimes the metrics that you look at don't result in value. Mm-hmm. So an example I'll give, people are probably very familiar with Polymarket. So Polymarket runs a very large prediction market. It's been growing dramatically. One of the secrets of their success is they actually have all their transactions settled on blockchain. But there's a token called, it's called POL, but it's been renamed a couple times, that is the blockchain where they're using it. When you look at the So the transactions are happening there. But when you look at price action, it actually hasn't followed. And so there's reasons for that, and that's part of our job, is to try to figure out why. So adoption isn't like, it's not as simple as just putting a bunch of user metrics. It's kind of like when Facebook came out initially, there was no revenue. Then the question is, what metrics should you look at if you're going to try to assign value? So everything has their own set of metrics. The whole market has different metrics, and it's fascinating as the market's evolving. Looking at those adoption metrics, stable coins, tokenization, all these big topics that were talked about in the previous panel are going to have all their own set of metrics, and we could talk about those too.
So Greg, are there any, adding on to the first question and then further to what Joe was just talking about, are there any metrics in particular that you monitor that are your favorites, or does that change over time?
So I think Joe alluded to this, a lot of the metrics in crypto, whether it be volume, fees, what have you, are very reflexive to crypto price. And so, at the highs, the metrics look phenomenal. At the lows, they don't look so great because kind of price moves, momentum starts, fees got higher, there's more of this, there's more of that. And so it's tough to look at that as like an adoption perspective. I do think, from investing, if we're talking about investing, if you just draw a line from the lows of 2022 to the lows we just saw in the past couple months, we hit roughly 15,000 in 2022. If the low just hit around 60,000, over those time period, you'd 4x the adoption if you want to think of it in simple terms. But yeah, I think a lot of metrics are misused, and to Joe's point, don't necessarily follow through. Like volume is a very easily inorganic or faked metric. I think stable coins is probably a better thing to look at because any ecosystem, any kind of marketplace thrives on that liquidity, and that's a real-time assessment of how much is coming in or out of the market in aggregate. But I think like the real adoption we're seeing is that, through these price cycles, I think the infrastructure has gotten better, the products have gotten better, that after kind of this last 4 years, we actually have things that are challenging the incumbents, right? So, whether we see it in clarity with the lobbyists going to work, trying to shut down stablecoin proliferation, or we see the CME suing the CFTC because Hyperliquid is starting to take share in these markets. Now we're seeing the stuff with this tokenization or securitization of kind of traditional assets. I think that's a little bit behind stablecoins and perps, but like that's adoption. Like the incumbents are having to adapt or fight what's being built on these rails, right?
Yeah.
And that means you build something good enough that people are paying to use it and choosing it over their prior option.
That's an interesting metric
Right.
that you don't hear people
Right,
talking about. Yeah. All right. So with that, let's move on to the second topic we have here, which is separating real businesses from crypto narratives, because that's you always as an investor, I'm always trying to discern what's narrative, what's real, what's hype, and where should the investment dollars go. So every cycle has stories that sound compelling. We've been through all of them. How do you separate the genuine product market fit from the narrative-driven hype in the market? Why don't we start with Joe again?
Sure. So I think for us, what we like to focus on when we're making investments is actually trying to stay away from projecting where the world's going to be or where something's going to be in like 10 years. Too far out, who knows, a lot changes. There's so many examples in history of technology that looks great at a moment and then changes. So when we're, the sort of the pattern of things that we're looking at for investment is, things that have value, and then the value is defined, often on things we kind of recognize, right? Like some form of adoption, maybe it's cash flow, maybe it's, kind of some sort of multiple to that. You might comp it to things we understand in the traditional, equity markets, et cetera. But then we look for catalysts. So, everything that we're investing in has a sensibility of re-rating, right? Where should it be and why? So when we think about, that approach, it just tends to lead to things that, that are working. Because we're just not going to invest in something because we dream it's going to be something in 10 years. And there are people who can do that. It's not what we do. We just focus on like, what's the catalyst? Why, what is coming up? And it might be in the next 3 months, might be in the next 6 months, might be in the next year. So we do have some duration. It's not like we're waiting for, so we do want to appreciate that some of these things do take time and aren't visible, but it's really doing that hardcore fundamental underwriting, and having a catalyst. So for us, that is kind of like, part of the story. Everything that we own, we don't really necessarily own to, for an undefined amount of time. It's actually really to that. So it makes it a lot easier. So a lot of stuff just doesn't fit, which results in us really not doing a lot of things and a lot of stuff, but then having concentrated positions in the things that we do find that edge in. And you do find that the opportunity changes. So I mentioned we actively trade. There are points in time in that there are themes that are kind of coming out. Today, one of the big themes clearly are stable coins and tokenization. That's like a huge theme. Probably 3 years ago, that wasn't really quite a theme, and wasn't, there's probably more focus on other activity. So what you're doing today and what the opportunity is changes. What's hard about today's market, maybe versus others, is to make money, you can identify a theme like stablecoins or tokenization, but then the next question is where do you go put your investment to actually take advantage of that? Yep. And today the really obvious thing to us is it's about platforms. So it's about organizations that are taking advantage of it. It's very possible M&T, because of what they're doing right now, is going to make a dramatic, we don't have that in our portfolio, but we'll pay attention to that. Mm-hmm. There's a company called Figure that went public last October, has a market cap of around $8 billion. It's a mortgage company, but they settle all their mortgages on chain, on a blockchain called Provenance. So it's a mortgage business, okay, so that's interesting. But what's really interesting is because of, it's a great mortgage business, they're growing, dramatically, but they're actually able to compete with the government-sponsored entities because of their cost of settlement. So the government, just to give you some examples on that one that they'll quote, to originate a mortgage, for Fannie Mae or Freddie Mac, it probably costs about $10,000 for a $200,000 mortgage. For a Figure, it costs about $1,000. So that's like a 5% differential in cost of origination. What that results is in them being able to compete with the government-sponsored entities who have competitive funding because they're government-sponsored and be able to originate. That's interesting, and it has a different value and it's accruing for their thing. So, the opportunity in that case is about is understanding that the blockchain is actually enabling them to be much more competitive than many of their other mortgage originators. So that that's today's world where you're seeing big organizations, maybe companies like Ripple, maybe companies like Canton and Digital Asset Holdings, which are Srini mentioned are going to be talked about talking later today, are ways to play tokenization. Thinking about the institutions that are going to take advantage of it. Stripe is a huge user and putting a lot of activity or energy into stable coins. So Stripe actually might be an interesting way to play. Yeah. It's not in our book right now, but I mean, it's something to consider. So it changes through time.
And from what you're saying, it's not always the impact on the revenue side of the company. It's a lot of times it's the costs that get cut down.
Yes.
Time. Okay, really interesting. So Greg, following on to that, is there an investment you avoided sometime in the recent past specifically because the adoption wasn't as real as was the perceived narrative?
I think this happens quite a lot. I mean, it's almost as important as the stuff you do invest in. I mean, there's a few of them. I think at the end, so Joe mentioned Hyperliquid. It's our largest holding. We farmed it before it launched. We bought it at the day of its quote unquote IPO. And given its success, a lot of competitors came out, and I think namely the Lighter was probably the most successful of the competitors. And when we watch it, first off, we've used every perpetual exchange that's ever existed, given I think that's been just a favorite area of us since we started. And we used the product, and it just was just obviously inferior. More expensive, wider spreads, less assets, less leverage. You couldn't trade it in size. You couldn't trade anything there in size. A lot of their marketing around it was kind of false, like free trading. There's no such thing as free trading. You're just paying someone else, right? And then they had these massive metrics, particularly around volume. And so, when we looked at it, it's like, all right, well, if you look at every other exchange, there's roughly 2 times the volume to open interest, right? So volume is, 1.5 to 2 times open interest. Maybe that spikes in very volatile days, but generally that's the case. They're running at like 10x open interest. And so that's just obviously inorganic. It's obviously wash trading. It's fake, but it's there to be designed to either A, earn incentives, which they had a campaign around, or B, inflate metrics because you have a token coming, right? And what we saw, and we kind of figured this would be the case, once the token was live, that a lot of those incentives went away, therefore the kind of inorganic volume would go away. The thing it had an initial pop, but effectively went down, 75% from its initial token price. It's had a bit of a recovery with some relationship with Robinhood. But again, there's no metrics that support kind of what the price is doing, right? So it's all kind of some speculative premium based on zero results. I think the one that's probably more pressing right now is Solana. I think Solana is the king of inorganic metrics. And there is certainly zero value accrual to the SOL token, right? So similar to Polymarket and Matic or Polygon, the L1. I mean, SOL forever and eternity will be a negative cash flow generating asset. There's nothing that comes back and burns, and it has a very high inflation rate. Therefore, it is a negative cash flow asset, and there's nothing they can do to change that. I think the current narrative around it is around cash equity trading on the Solana blockchain, and they have these massive numbers of volume, but then you look, and there's like $20,000 of liquidity supporting tens of millions of dollars of volume, and that's just obviously people passing it back and forth. They set up pools with zero fee so that people can do this, right? So I think it's really getting to like, all right, what are the headlines, like using things. One, you have to use every product and see if they actually are novel and it's better than either what's existing outside of crypto or within it. And then diving into the metrics, it's like, well, can this persist? Is this organic? And does it even flow back to the token in any way? And I think, I got a bunch of these, but those are two I think are kind of.
That's real. From my standpoint, it's really interesting to hear that because we have another manager in our book who has an opposite point of view with respect to Solana.
Yeah.
I find that kind of stuff really fascinating. How am I doing time-wise, by the way?
3 more minutes.
Really?
Oh wow.
Okay.
That's speed.
Speed. Okay. So let's go to number 3. Where does value actually accrue? So, yeah, boy, how are we going to cover this? I need more time. So, and I'll put it with the follow-up. Are we entering a world where equity investing becomes more attractive than token investing? So I'll start with you, Greg, on that one.
I mean, no one asked that in 23, 24, and 25.
Right,
And crypto
yeah.
is doing quite well. So I get it asked now all the time. The answer for us is no. First off, I think it's a little bit of a signal that now no one wants tokens and they only want equities after, name your sector of equities that just ripped hundreds of percent. I think that's a little bit part of the bottom indicating we're seeing in crypto. But
So just to be clear, when you say no, you mean you still value token investing relative to equity
but like
investing?
what we're saying, we're talking about value accrual, which effectively means that we're looking at tokens that are very, very much look like programmable equity, right? And I think in crypto there are certain structures where there is actual equity and token, and those we avoid entirely because the team has a fiduciary duty to care about the equity more than they do the token, right? So in that we'll just probably avoid both, or maybe in those instances the equity looks better. But I think, So for us, no. And some of that is just, I just don't think people that have an expertise in one thing can all of a sudden pivot to something else. And like generally speaking, over time, when people do that, the results don't follow. Some people, maybe they do have that ability. I don't. And I think also then if you leave, it's hard to then assess what's going on in crypto which there's been plenty of good things to accumulate this year if you're not looking at it every single day.
Right.
So we're kind of staying true to that. If people have an edge in things outside of tokens, they should absolutely pursue it. But I think for us, you have to kind of know what your core competency is and just stick to it and get better at that.
Joe, you have anything to add to that?
I would, and I respect Greg's point, kind of being disciplined in the area. We set up our business to be agnostic about where we invest, because I don't know exactly where it's going to accrue. It could be public equities, it could be private equity, it could be tokens, it could be a combination, and you don't really know. And so I think it's kind of situation specific. So we will trade public equities, we'll trade it all, and we do have opinions on where that's happening. And sometimes there are things that look like they may be conflicts of interest. So.
Okay, so now I'm going to incorporate it into number 4. I got to ask the macro question. How do you guys each think about macro, meaning traditional macro as well as crypto macro, and managing risk and exposure in your portfolios? And I'll start with you, Joe.
So I'll do short because I know we're tight on time. I would say, okay, there's traditional macro and traditional macro. 5 minutes. Okay. Traditional macro really matters to anything that you're doing when you're investing because it matters. I mean, I think it's kind of like a sort of obvious. It doesn't matter all the time, though. There are times, for example, when there's a lot of liquidity being pumped into the system, whether it be because of Fed, whatever, and you have high correlation amongst assets, whether it be equities or tokens or whatever it is. And then there's times when you have recessionary conditions or risks, tariffs, wars, elections, et cetera, that can also be very, very negative. So from a portfolio management point of view, we want to be very, very mindful of what's happening on the macro side because it informs how long you want to be, it informs maybe the types of things you want to be in. You certainly want to be able to be defensive and protect capital when things are going wrong. So our style is to do that, so macro matters. For crypto, it matters too because just because macro is doing one thing doesn't mean crypto is going to follow. But you will find actually crypto does follow and a lot in extremes. So when the market's really, really, kind of bullish or a lot's happening that's very, very, sort of positive, supportive, you'll find crypto tends to move with it. And if you have recessionary type conditions, and then you have the in between. The hard part about our business is you kind of can't let one just decide, how you're going to position
so
for the other.
You're referring to like the liquidity backdrop of the market overall.
Yeah,
which
so
drives everything.
it's complicated. So you kind of have, unfortunately, our job is like, you got to look at the macro, then you got to look at the digital sector in a way, and then you got to look at the investments. So it's you kind of multiple layers, but I think you have to pay attention to macro. We spend a lot of time on that, and I think it can, really help protect capital in over long periods of time.
Greg, you have any different opinion on that?
No, I think both, the crypto macro and traditional macro are important. I think crypto responds very strongly to almost regime shifts into traditional macro, right? And so like what we've been going on more recently, if you look at when rate hikes got priced in, that was in mid-May. And then for weeks straight, you saw multiple 9-figure day outflows from Bitcoin. I don't think that was from Bitcoin ETFs. Like, I don't think that was a coincidence. And then on the back of kind of, lower than expected CPI numbers, inflow started back up. Bitcoin's having a positive month when NASDAQ is negative, right? So I think, and if you look at the prior two kind of bear markets for crypto, they were 22, they were 2018, which are both rate hike regimes. I think there's also regime shifts around the dollar, right? So a strong dollar above a certain threshold, those regimes are generally bad for crypto.
Yep.
Below it are generally, and those things can be related. But I think, within that, right, those are kind of very long-term environments. And I think the crypto macro cycle kind of plays out just more rapidly. And a lot of it within that. And I think, the most important thing we look at is largely around leverage, right? So like, where is leverage built up? What are people levered in, right? So if there's a lot of, people with open interest in Bitcoin is very different than open interest in memes. And and usually the more we run, the further out the curve that leverage goes as a percentage of total as well as aggregate. And then, you get these deleveraging cycles, which generally happen around any negative in the macro environment, right? So we could be over-levered, NVIDIA misses earnings, and somehow crypto needs to go down 25%. That's because the crypto macro is extended and over-levered, and any little spark from traditional macro took it down.
Right.
So like, yeah, both are immensely important.
So before we finish, I just want to touch on this last item of looking ahead. So, let's just imagine it's 5 years ahead, 2031. So, and we're looking backwards. What do you think investors underestimated in this year, 2026, and what, if anything, they got right? Like, how would you scorecard the investor environment right now?
So I'd say like the things that I think are very exciting. I mean, the amount of focus on getting the right regulatory and environment set up in the United States for crypto to sort of work and really grow is cannot be underestimated. But it takes a lot longer than people think. So, for example, the Genius Act came out last year. But if you ask Goldman what their regulatory capital is on a stablecoin, it's still 100%. It's treated worse than equity, right? So that doesn't make any sense, but that's just because it takes some time for that. So, I think the effects of what's happening is going to really be seen probably in the next 3 or 4 years because it takes a while. Clarity Act is still kind of in process, but the implications of it are huge. Stable coins and resolving these issues of what is a token? Is it a security, not a security, and how should it be treated? These are really important issues for the sector. And it's also, sort of the combination of AI with digital is really, really interesting. It's software with software. So agentic, payments and all these types of things. Very excited about. The way to play it to me isn't quite obvious, but it's one you're supposed to be paying a lot of attention to. And I think the tokenization is kind of like, there are inevitable things. It's inevitable that everything's going to get tokenized. Right, so Larry Fink says it. It's kind of obvious, but then the question again always comes to, great, now you're going to make money.
Yeah, right.
So that's but I think tokenization, stablecoins. I think we'll look back 5 years from now and it'll be as big, or if not bigger than some of the biggest bull calls are for those.
Greg, anything? To add?
So I think the good thing is that nearly everyone is focused on, like, if you have a token and no value accrues to it, there's minimal value there, and the games that have been played around that over the year probably as a lack of regulatory clarity or regulatory punishment just won't be rewarded in the future. I think the unlock that people are probably underappreciating is one. Well, most people I talk to don't realize there are these kind of on-chain businesses that make a ton of money and are very profitable, but also, we talk about adoption. I think one of the biggest promises of blockchain from the beginning is balance sheet efficiency, the composability of assets. And when you really get people trading tokenized whatever on chain, it's when the margining systems are robust enough to reflect that composability and efficiency. And I think we're going to see that. And I think that's when you'll start seeing the large traditional players actually move more assets on chain in a large scale trading capacity. I think we're seeing some of that now. Right, like with oil or commodities or some of the pre-IPO stuff, we saw it happening on Hyperliquid. But I think once these margining systems use the kind of embedded advantages blockchain has to compete with kind of traditional margining systems, I think you'll start seeing a lot more flow on chain, and I think that will happen sooner than later.
Which speaks to what Brian was talking about at the opening of the conference, and that is a great segue to end the panel.
Yeah.
Thank you guys very much. This is really a great talk.